Hello everyone, good day. I am Claudine Ladao and I will be your reporter for today's topic. But before that, let us have a short recap about our discussion last meeting, which tackles about net present value or what we call NPV. Net present value or NPV is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. To calculate the NPV, we need to follow the formula, which is NPV is equal to CT over 1 plus R raised to T subtracted to the CO, where CT stands for the net cash flows during time, R stands for the discount rate, T stands for number of time periods, and CO stands for total investment cost. Always take note that if the result of the NPV is negative, you should decline the offer. But if the result is positive, then you should accept the offer, for it has more inflows to get than outflows to give. So, without further ado, I would like to welcome everyone for the subtopic 2 of Unit 3, which is investment. Upon doing the discussion this evening, we will be able to define and understand what is investment, and we will be able to identify the different types of investment. So what is investment? Investment is defined as a strategic allocation of money and resources with an expectation of achieving some benefits in the future. It is clear that an investment is a commitment of a person to put or invest his or her money in an organization or a company. Investment should be grabbed only when you have an extra resources available. It means that an investment happens when a person has an extra resources or an extra money. It is because as a human being, we need to prioritize our needs in order to survive in our daily lives. After all, these investment opportunities are not always once in a lifetime. Always remember that if you miss one today, you could grab the next one soon enough. And next, investment should not be our main income. This means that we should not be dependent in our investment, in a reason that mostly of our investment return is given annually. And lastly, investment requires additional risk-taking, for it is very risky and quite unpredictable on what will happen in our investment. Either it will fail or it will grow. In continuation of our discussion, there are different types of investment, and it is divided into 3 groups, which are the fixed income and equities, alternatives to fixed income and equities, and lastly, the other investment assets. Under the fixed income and equities, first we have stocks. Stocks refers to a security that signifies ownership in a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stocks they own. The units of the stocks are called shares. For example, I invested money to a corporation to buy a stock in which I become a shareholder in that corporation. Some advantage of investing stocks is it has unlimited upside. This means that an investor of this kind of investment can get an unlimited return as long as the operation of a business is doing well. But on the other hand, investing in stocks is the riskiest of all assets, for a reason that it has no guaranteed return once the corporation will fail. And It can lose even more than 50% of your money in just one day. The second type of investment under the fixed income and equities is bank deposits, in where money is placed into a banking institution for safekeeping. Bank deposits is the common type of investment in where the availability of funds depends on the investment opened. There are different types of bank deposits: savings account and time deposit accounts. In savings accounts, it offers interest but not that significant, and it is the most common among individuals. While in time deposit accounts, we can earn highest interest rate, but it is not always available for withdrawal. The advantage of bank deposits is known income based on outstanding principal and current interest rate, which means that the higher the principal invested, the greater the interest we can earn. But on the other hand, bank deposits has a lower interest rate compared to bonds, and settlement risk if the bank closes. And the last type of investment in fixed income and equities is bonds. Bonds refers to the investments where an investor loans money to an entity which borrows funds for a defined period of time. For example, a government or an organization borrows money to the investor to provide money that is needed for their project. Its advantages are: bonds has a periodic payment for a certain period, and you cannot lose money if bond investment is held until maturity. But if not held until maturity, investor can either gain or lose depending on the prevailing interest rate at the time. Under the alternatives to fixed income and equities, there are two types of investment: the mutual fund and the unit investment trust fund, or what we call the UITF. Mutual funds is an investment that is made up of a pool of funds collected from many investors for the purposes of investing in stocks, bonds, and similar assets. For example, a company doesn't have enough capital to make a project, so they will find many investors to collect and gather enough money. The combined holdings of mutual fund are known as its portfolios. This kind of investment gives an advantage to the small investors access the professionally managed, diversified portfolios of equities, bonds, and other securities, which would be quite difficult to create with a small amount of capital. But the disadvantages are the investors may have management fees, and values can also fluctuate just like the stock market. And next, the Unit Investment Trust Fund, or UITF, which is similar to mutual funds, but this is managed by banks. Its advantages are it has no entry and management fees, and easier access because clients can open an account in any branch of the bank nearer to them. But on the other hand, its disadvantage is they has no rights such as dividends and voting rights. And lastly, under the other investment assets, we have currencies, commodities, real estate, and insurance. But first, let us define currencies. Currencies, generally accepted form of money, including coins and paper notes, which is used by government and circulated within an economy, such as US dollars. The advantages of currencies is that it is the largest market in the world in terms of trading volume. So much liquidity. Unlike stocks, commodities, and other assets, currency itself is a medium of exchange which people can use to transact. And the disadvantage of currencies is it uses margin trading, which allows clients to be more than their capital. But it may also be an advantage. The second type of investment is commodities. Commodities refers to a basic good used in commerce that is interchangeable with other commodities of the same type. Some examples of it are gold, nickel, and oil. The advantages of commodities are natural hedge against inflation, negatively correlated with equities and bonds, and the disadvantage is it's empirical to invest directly considering storage, transportation, and insurance costs involved. The third type of investment under the other investment assets is real estate. This includes lands and any improvements such as house and lot and condominiums. This kind of investment is also common to us, in which some people buy properties and make condominiums to gain income. Its advantages are: first, generally appreciates over time because land gets scarce. Second, it can be a source of recurring rental income. And third, it may also be a hedge against inflation-linked rent escalation clauses. But on the other hand, it has also disadvantages, like huge capital needed and financing can be difficult because this land, house and lot, and condominiums can consist greater capital for a reason that it is a scarce nowadays. It also needs maintenance so that the property will preserve its value. And lastly, real estate investment is illiquid because it is very difficult to sell. And the fourth and the last type of investment under the other investment assets is insurance. Insurance, defined as a contract in which an individual or entity receives financial protection against losses from an insurance company, such as life insurance and educational plans. Insurance gives the insured individual the cash to deal with unforeseen adverse financial consequences. This means that through having an insurance, we will receive money from the company in case of emergency. It may also provide certain tax benefits such as tax deductibility and tax-free provisions. But on the negative side of insurance is that insurance premiums may be costly, and on some traditional insurance plans, no sickness or death until a certain age may mean not getting any benefits at all. And some insurance companies can go bankrupt, like college assurance plan. And always remember that the types of investments are divided into three groups, which is first, the fixed income and equities that includes stocks, bank deposits, and bonds. And second, the alternative to fixed income and equities, which includes mutual fund and unit investment trust fund or UITF. And lastly, the other investment assets, which includes currencies, commodities, real estate, and insurance. And that would be all. I hope you've learned something from me. Thank you for watching and God bless.